evening, everyone. Thank you for joining us at this hour. I know it's so beautiful outside, but thank you for coming for this important session. I have with me Bruce. He's a tax lawyer with Baytel Tax Law, who practices primarily focuses on tax dispute resolution. He represents individuals and small businesses in CRA audits and objections and appeals at the Tax Code of Canada. Bruce is experienced with representing clients in income tax and HST GST disputes related to real estate transactions. And I think from his firm, Baytel, he tells me that he's the one who's dealing with the most number of real estate files. So with that, I pass it on to Bruce to go ahead. Yeah.
My pleasure, Tom. And once again, thanks everyone for joining. It's very flattering to know you'd all rather hear me talk than go outside, enjoy the beautiful weather. So I have a brief slide deck that I've prepared for you, and that'll cover some of the basics to look for in a real estate dispute regarding taxes to the CRA. And then we can do some questions and have a nice discussion after that. Yeah, perfect. So whenever anyone's doing a presentation, the question of why is this important is always top of mind. So this is a quote from the recently released federal budget that the government just put out last month. And as you can see, they're putting millions of dollars towards addressing, at the end there, you can see tax noncompliance in real estate transactions. And if you actually go back and look at the previous budget and the budget before that and the budget before that, you could find similar phrasing. This is definitely an area of focus for the CRA. They are sending out tons of audit letters regarding people's real estate transactions. And I think for most Canadians, it's a very high stakes process, and it's one that a lot of people aren't expecting. They're very casual about their real estate transactions in general, and they can be caught up in a six-figure tax dispute very, very easily. And so that's what I'll be talking about today, both in terms of how to avoid being in that position, and then also if you are in it, what to do about it. So can we go to the next slide, please? So we'll start off with some basic concepts. I think it's important to lay the groundwork for the treatment of real estate transactions from a tax perspective in Canada. And then after that, we'll do some questions. So next slide. So this is really the core of it. This is a good visual if you want to conceptualize what the three possible outcomes are when you sell a property in Canada. So obviously, we'll start on the left with the worst case scenario. If you're selling a property and it's business income, that is 100% taxable, right? So let's say you buy a property for $1 million, you sell it for $2 million, all in. That's $1 million taxable taxable gain to you. So that's subject to tax, and that's the worst thing that can happen from a tax perspective. Oops, we went back one. In the middle, there's capital gains. So, of course, capital gains inclusion rate is 50% for now. That's limited time only. I think most people are aware that the government is bumping that up to 2/3 when you're over 250,000 in a year. That starts June 25th. And I think Tom and I might talk about the practicalities of selling a property to take advantage of the lower rate. We'll touch on that later. And then on the right, there's the principal residence exemption. That's the best case scenario. That's what everybody wants. If you sell a property and it's allowed to have the principal residence exemption applied to it, there's no tax. You get an amazing gain. But what we're going to talk about today is the CRA challenging people claiming the principal residence exemption. They don't just move it over to capital gains. They actually bump it over the fence and back into the business income side of this. And I should point out one last thing. Technically speaking, there's two outcomes. You either have business income or a capital gain, and then that capital gain can be exempt through the principal residence exemption. So that's how you can think of it. And I think with that, we're ready to go to the next slide. So when the CRA is thinking about how to classify a sale of a property. These are the considerations they look at. This is actually the law, these six. And the question I often get asked is, if I do this one thing, is there any way that I can avoid having the sale of a property be business income? And the answer to that largely is no, because the CRA wants the full story. So as you can see, they want documents and proof of your intention at the time you purchased it, why you sold it, how long you owned it. Do you have a history of buying and selling properties and fixing them up first before you sell? Can they find that you took, renovation permits out, or all that? The nature of the property sold refers to, are you buying in highly speculative areas? So they want the full picture of a taxpayer, and based on that information, then they decide if they want to challenge your claimed principal residence exemption, or if you claim a capital gain, they can also bump that over to business income. So we can go to the next slide. Oh, that's a bit strange. So I don't know what's happening with this slide, but we can go to the one after this one. Yeah, this. So the the previous slide talked about the property flipping rules. I'll just describe them. There's a technical glitch with the slide deck, I guess, there, but so there's the general rules that I talked about, where they consider the different factors, those six that were up on the screen. And then there's also the new property flipping rules. People probably have heard about that in the news. It got a lot of press. So what the property flipping rules apply to are when you sell a house in under 365 days after you bought it, and that's starting in 2023. So basically, if you're buying and selling a house in under a year, what the new rules say is that you're deemed to be in the business income camp. That's how it works, unless one of these exceptions apply. So as you can see, there's a lot of exceptions here. And I think for most people, if you're buying a house with some intention to live in it, or even rent it out, probably one of these things would have to happen for you to sell in such a short time frame. Obviously, I think most people, as long as they're not genuinely flipping, typically wouldn't really plan to buy a place and sell it in a year, because of even just the transaction costs of doing that would probably dwarf your profits, or any money you would make. And if there is profit on the table, it would be in business income anyway. So that's something to keep in mind. So if you're to summarize it all, if you're buying and selling in under a year, you have an uphill battle, because you have to prove one of these exceptions for it to not be business income. If you're over a year, the standard rules apply, which were on the previous slide, where they look at the full picture, and they want your full story and reasons why you're buying and selling that property.
And I think, Bruce, we were talking about, if you go back to the previous slide there, you have to keep actual receipts or a card. Like I know we were talking
Right.
earlier, where you really didn't get along with the neighbor, right? And so if a dispute arises, like after you moved in a year or two, I mean, a month or two, and then you have to actually create that, okay, you went to the court, or there was some issues that happened, and you really cannot live there. So you have to keep all communication dates of all these happened, because once CRE comes after you and questions any of these, like, a marriage breakdown.
Yeah.
I mean, you cannot fake a marriage breakdown to
No.
sell and move, to flip. So there, and then threat to personal safety of the taxpayers, where the neighbors, you're not getting along, or maybe that's a crime area, or any of those, right?
Yeah, I think that's an excellent point, because it's one thing to just say one of these things applied to you, right? Oh, there's a threat to my safety. Well, okay, how? Prove it, right? And that's really probably above everything else that I'm going to say today. That's the one point I want to drive home. Your own personal intentions with respect to a property often look a lot different to the CRA. And they're coming at this from the perspective of, the government spent a lot of money and they got to get it from somewhere. And real estate transactions are a place they've identified as there being a lot of undisclosed taxable income. And to that point, I think they're largely right. I think there are a lot of people who are house flipping like crazy and they're not claiming any of it. But the problem is a lot of legitimate people are getting caught in the crosshairs. So you not only need to have a story that makes sense, you need to have documents. So let's use a threat to personal safety as an example. You know, what happened? Did you file a police report, right? There must be some kind of, document you can provide that establishes what actually occurred. And if there isn't a document, you should probably, at the time it happens, try to get one, because the CRA doesn't audit anyone the day after you sell the place. It happens 3-4 years from now. So think about that. If you were trying to prove what you did 3 or 4 years ago and people have gone away, you don't live there anymore, you don't know anyone, it's a lot harder. It's way harder. And people, they lose documents. Oh, I had that, but I threw it out. I hear this all the time. And it really causes a lot of issues for people. So thank you for that. That was a really good point.
Yeah. And I know, I mean, couple of years, it was 3-4 years ago, where one of our clients who had moved into a brand new house from the builder,
Yep.
and then I think they had some issues with, basement flooding. It could be that. So what I think in those cases, if it's a persistent latent defect, I would say, is that a cause for them to sell and move?
Well, again, it can be. That's a totally legitimate reason. That's not a business intention, right?
Right.
But the question is, you're not dealing with someone who is just going to believe you, right? So if your basement's flooding, did you call somebody about it? Did you hire contractors to fix it? What did you do about it? You have to think about it like this. This is the example I always give to clients. I think it drives the point home well. Let's say you're in the forest and you watch a tree fall. You see it with your own eyes. You know that it fell. You know it. And then 4 years later, the CRA asks you to prove it. How are you going to do that? Right? It doesn't, that's what you're up against. So you need to, at the time it happens, take a picture, do whatever else you have to do to find some way to prove what's going on. And to be a little bit defensive. Again, I said this at the beginning. I think a lot of people are very casual with real estate, and they change uses of properties, they buy and sell, and they don't consider how it's going to look to the CRA, who are, as I said at the beginning, they're looking to crack down on this.
Yeah, and they have a lot of funds put aside
For this exact reason. Yeah, and I can tell you, our phones at my firm, we represent people in these disputes regularly in the 6-figure range. And just think about how much you can gain on a property, right? Everybody knows it's not unheard of to gain 500,000, even 200,000, $1 million, right? If that's all of a sudden, instead of it being principal residence exempt, it's now business income, plus there's interest on the debt. Penalties can apply as well. Those are huge. And the CRA often doesn't, they don't accept all your expenses, right? And people lose their expenses and their receipts for how much work they did. The bill can just balloon like crazy. So that's why regular people can walk into a deep 6-figure tax dispute just out of nowhere, and it totally catches them off guard pretty much every single time.
And they usually audit only after 3 or 4 years.
So yeah, well, yeah, but that's their timeline. But then interest, of course, is ticking. It's owing from when the transaction, the date that it was owing. So that would be when your return was due. But I think we're ready to move on to the next slide. So this is the principal residence exemption. So it's worth talking a bit about this. This is what everybody wants. This is obviously, I think, in terms of a tax law, that probably this is the most popular one in the whole country. So the conditions are pretty what everyone expects. It has to be some kind of a property, so a house, a condo, anything like that. You have to actually own the property, and you or a family member must ordinarily inhabit the property during the year. the key part of this, and I think it touched on some of the examples we were talking about actually before the meeting. You only get one per family unit. That's the term that's official CRA policy. Family unit is if you're married, it's the two spouses plus their non-adult children. And if you're unmarried, it also can include your brothers and sisters, parents, I believe, as well. So worth considering looking into that rule. If there are multiple people involved, there's a lot of intergenerational families living and giving each other houses and helping each other out. You only get one per family unit, so definitely worth doing a bit of planning on that if you think it might be an issue. And of course, last point, extremely important. You have to actually designate a property as your principal residence. It's not something you just get. You actually have to report it correctly on the T2091 form and Schedule 3. That's for 2016 and beyond. So that's been the rule for almost a decade now, but people still need a reminder. So that is, those are the rules, but we can go to the next slide. Okay, so this is what really catches people off guard, and we'll go to the next slide really quickly. And this slide, I apologize for all the text, but I'll just explain what it means. So what I was talking about before was income tax, right? Everyone is familiar, at least to some degree, with income tax. We all just filed our income tax return, right? So most people think in terms of income tax. Now I'm talking about sales tax on your house. So it gets, believe it or not, worse for people. So you can owe income tax on the sale of your property and also HST. And how that can happen is if you buy a property and you either knock it down and rebuild the new house, or if you do what's called a substantial renovation, meaning a total renovation gut job. A lot of people get into this situation. They buy a fixer-upper. They either, maybe they intend to live in it, for example. That can incur HST if you actually sell a place. So that's 13% on top of whatever you're selling it for, which can be, in addition to the income tax bill you have to contend with, now you have HST too.
What about if you do a basement apartment, a brand new basement apartment?
If you just do a basement apartment in a house, that would not, you'd be okay for this HST part of it. That wouldn't be a substantial renovation. So if the rest of the house was not renovated, that's a great question. You'd be okay. Don't mean to scare anyone, but a lot of people run into this situation where, and I'll give a classic example from what I see. People want to upgrade their life. Right? They've done well. They want to have their dream house. They've hit, they're 50, 60-year-old. They say, you know what, I want to live in this amazing house that exactly suits my specifications. So I want to buy a place, knock it down, and rebuild. And honestly, I have at least 5 files that are exactly like this. And then something along the process when they're rebuilding the place changes. They lose their job. Somebody gets sick. Something else happens, and they say, okay, let's just finish building the place and just sell it, right? We can't live there for whatever reason. CRA will say, or they might say, but if they're auditing you, what they're saying is, from day one, your whole intention was to do this and sell at a profit. That's how they see it. And that's a tough, if you're in that situation where you sell it before even moving in, it's a tough argument to make and say, no, I genuinely wanted to live there. And I've won files like on this, but it's always tough. It's a battle every time because it's so much time's gone by. People lose documents. The story has to line up exactly right and make total sense. And it's, as always, it's high stakes. So we're not talking owing 10, 20, 30,000. It's 13% of what you're selling a Toronto house for or a Vancouver house for. It's a lot of money. So I think we can go to the next slide. This slide, again, I do apologize for the text, but basically there's different options. So if you're selling it, if you rebuild a house and sell, of course, HST applies. If you rent it out, a deemed sale can happen. If you do a fixer upper though when you actually live in the property. This is what the last bullet is saying. There is an exemption there, but you have to establish that you actually live there. So it's similar to the principal residence point. Not exactly the same thing, but similar. I know this is very confusing stuff, but maybe we could talk about it afterwards. Let's go to the next one. Yeah, change in use. So this is another important concept, and I'm almost done. So please bear with me. When you change the use of a property, that's technically speaking a taxable event. So it's a deemed sale. So you didn't actually sell, but you're deemed to have sold and reacquired the property at fair market value and then reacquired it, which is what the second bullet's saying. There are elections you can use to opt out of this, 45 sub 2 and 45 sub 3, which are those 2 bullet points on the third point there. So you can extend your principal residence status going into the future or pulling it back. So this applies where you buy a rental property and then you stop renting it out and you move in. There's an election for that to say, okay, that was my principal residence for the years even before I moved in. So you can do that, or the opposite. If it was your principal residence, you move out and you rent out the place, you can extend for up to 4 years to avoid the deemed sale rule. But again, people are very casual with real estate, right? If you're doing all this stuff, you're moving in, you're moving out, you're renting it, you're doing this, you're doing that, you can easily stumble into these rules and create a real mess for yourself. So next slide. And okay, best practices. Were you going to say something?
No, I was just going to, I mean, once we finish this, there are a lot of the questions that we were talking about would be based on some of the topics you're talking about.
Yes.
So once you complete, then we go to those questions.
Okay, perfect. Yeah, that's great. And I thought it was important to at least go over what the basic rules are before jumping into how to avoid this. And we're on the last slide now, so best practices. So right off the top, if you want to avoid having any of what I said apply to you, keep your records, right? And the best time to get records of something is in the moment when it's happening all around you. And I would also say that now that you know what the CRA is looking for, and now that you know what the stakes are involved, if you're selling a property maybe a year or two after you buy it, you should know that could be a suspicious real estate transaction, no matter what your intentions were. I would probably keep your records longer than what it says on here. Just hang on to them because that's the kind of scenario where the CRA could even go back farther. They do that sometimes, and especially if you're buying and selling a lot for even genuine reasons, they can often go back and pick up multiple properties and do this and say you have a pattern of buying and selling. So all of them are now business income. So that's what they're Canadian banks. So the banks typically go back 7 years. That's something to just to have in your head. Other countries I've seen it can be longer or shorter, but in Canada, they typically go back 7 years. So a lot of times, if there's a really old transaction on the list, we're dealing with multiple properties, that last one, sometimes we miss that cutoff and we can't get records, which makes it challenging. I think we can skip that last point. I know I'm dumping a lot of information, so let's go to the last one. So these are when I say keep your records, this is what I'm talking about. You want to keep agreement of purchase and sale, listing agreement, the listing itself, all your mortgage documents. If you rent a place, please keep the lease that you signed with the tenants, guys. And then if you're actually showing that you lived in a place, remember I said it's tough to prove. So how do you prove it? Well, one of the best ones is actually if you hire movers, keep that invoice. Why would somebody hire movers if they're not moving in and out, right? It's actually great evidence. Banking and credit card statements that are issued to that address. Same for utility bills. Ideally, it should be all issued to that one same address that you're living in. should be to your name, but utility bills are great because they at least show somebody's living there, right? Driver's license, make sure to change your driver's license to the new address as soon as possible. You can do it actually very quickly online. You don't have to go to Service Ontario and line up, so definitely be aware of that one. And lately, this one isn't on the slide, but Uber Eats, Uber to and from, Amazon. If the CRA ever challenged where I was living, my wife's Amazon by itself would prove beyond a shadow of a doubt that we live where we say we do. And the last point, of course, expenses. If you're doing any work to the property, keep those expenses. And I'm going to say this, it's not on the slide, if you're paying people in cash, which I know a lot of people do, just know if the CRA is challenging you, you're not going to have a receipt or an invoice to back up what you're saying. And if you go back to that tradesperson and ask for one, they're probably not going to give it to you. So
they'll be out of business.
Yeah, exactly. They'll be out of business very conveniently. So I would definitely keep all expenses to the property, because what can happen with that? I said it earlier. A lot of people put work into their home when they're buying a place, right? It doesn't even have to be a fixer upper. So if you put work into the property, maybe you put even like 100,000, let's say 200,000, and then you sell for 100, 200,000 more. So you broke even. You didn't make money or lose money. If you don't have those invoices and receipts, well, how does it look to the CRA? You bought it for this, you sold it for this, therefore you had a gain, right?
Yeah.
And you gotta say no, and we make those arguments too. We can look at photos, we have to do all this, but it's better to just prevent these situations from happening rather than have to go and fight it and hire me, and do that. And I think is there one more, or is that, no, that's the end. Questions.
So I know, Bruce, we had a lot of different questions, and I know I did send quite a bit to you, but I think with regards to denial of principal residence exemption, you covered it here.
Yeah.
As to what really would not cover and what would cover if it's under a year. And then the sale of properties being taxed as business income also you discussed.
Yep.
Right?
Yep.
And then HST, GST, recently renovated, we discussed that. Now, capital gains, capital gain increase in inclusion rate. Now, we did talk about earlier before our webinar as to, the rule is coming into on June 25th.
That's right.
Yeah.
That's right.
So it's very tough for people who are actually thinking of saying, okay, this is not my principal residence, and this is an investment property. I want to sell it, to actually avoid the capital gains, the extra. Now, as we all know, the first 250,000 is taxed at the old rate. So for someone who's actually having a gain of 250, you pay 50% of 250 based on your tax rate that you claim, right? So that hasn't changed if your increase in profit is only 250. Now, the new rule applies only if you make, say, over 250, 100,000 more, then that 66% is included for calculations of your capital gain. So for example, 100,000, 66,000 is actually included for your calculations for capital gain based on your tax rate. So if your tax rate is 50%, that's 33,000, right? So I'm just doing a rough calculation.
Yeah.
So what I think is, if you are planning to sell the property really quickly to avoid that extra percentage, and you're actually selling it lower, because right now, if you have an investment property, maybe it's not the right time to sell because there's so much supply of properties now.
Yeah.
So the gain that you're trying to avoid, you're actually losing out on the selling price.
I think that could happen to people. And it's really a math problem.
All right.
I think you have to sit down, crunch the numbers, say, okay, if I sell today, what can I get? How much capital gains am I going to end up paying? And then say, okay, if I wait till the higher rate kicks in, what do I have to sell to break even? And then it's it's a decision you make on a case by case basis. But I think you raised a good point earlier, which is practically speaking, if your house isn't on the market,
Yeah.
how are you even going to pull it off in time? I think it's too late.
Yeah. And we also talked about, I'm not sure, I mean, based on what we see politically, most probably, I mean, NDP will support it and it may pass, but we never know who's going to form the next government. If they'll actually repeal it, who knows, right?
Yeah, no one knows.
And so if you actually sold it to, get that gain, and then it actually goes back.
Oh,
So
that'd be sad.
Yeah. Yeah.
Yes, that'd be sad.
Yeah. So now I know we also talked briefly. So let's look at the other questions. What are the eligibility principal residents we talked about? How can I maximize principal resident exemption if I own multiple properties?
Yeah.
Like principal residence only applies to principal residents.
Yeah.
Right?
You only get one.
Yeah. Now,
So
the question I had while you were talking is, say, for example, we have cases where, there is, two people who were living together. They got separated and they decided that they're going to have another property, but jointly owned, and where the husband lives in one, the wife lives in one. Now, can they get exempted for both properties if they do sell after 4 or 5 years?
are they actually separated?
Yeah.
Okay. Yeah. I mean, if they get separated,
Or it
then
could
they're
be
now not a family unit,
Yeah,
right?
yeah.
And actually, that would be a point. I know where the rule is. There's provisions on spouse, and it says sometimes former spouse. So you'd have to check that.
Okay.
You would have to really be very particular about looking at the rules on that exact point. A lot of the rules have really small details that you got to double check.
Right.
But I know what you'd have to check,
Okay.
and that's what it would be. So it'd be worth looking into
Yeah.
if you're going to do that.
Now, the other question I had is, now we know with COVID, a lot of people actually was using their home for
Mhm.
office space.
Mhm.
And maybe, part of their basement or, part of their home was fully used for office space.
Yeah.
Now, does capital gains come into being when, for example, they're deducting office expenses, right? As office expense. So I think there is a very small exemption allowed on your tax return if you have a home office or something.
Yeah, you do get credit for that. It doesn't affect your principal
No, it
residence
doesn't. Okay.
exemption.
Okay.
You're totally allowed to do it. You're allowed to have both.
Okay.
So definitely, if you're using home office and
Right.
you're eligible, definitely claim that, because you can save a nice bit of money, and
Yeah.
it's better you have it than pay it to CRA. So
Now, if a family doesn't have a principal residence under their name, but is actually under a trust, and they have only that principal residence, are they exempt from a principal residence tax?
it depends on the kind of trust,
Right.
and if you're in that situation,
Right.
really you need some advice.
Okay.
So I would definitely reach out to, for sure, at least an accountant, someone to help you with that, because you're in a pretty unique scenario there, and be careful. That's all I'd say.
Now, we did talk about the reporting requirements for principal residence.
Yeah.
And how I know we always come across, families.
Yeah.
Right now, first-time buyers, they're having a tough time to actually buy properties.
Yeah.
So then we have the parents who are actually co-signing
Yeah.
for the kids for their principal residence.
Mhm.
So their name is also on title.
Yep.
So when the daughter or son, after 3, 4 years, want to sell their home with their parents on title, are they exempt for that property?
Well, that's a tricky one, because what I said before, you only get one. So if the parents are on title for the
But
kid's house,
parents have their own principal residence.
yeah,
But the kids, because they just co-signed, but they had to be on title.
Yeah.
For the kids.
okay. So I have clients in a similar scenario,
Right.
and what it hinges on is, if you're giving your kids money to buy a place, is it really a gift?
Right.
Or are you just using your kid as sort of a way you can invest in real estate and maybe, pay a lower tax rate when you sell.
Right.
And the concept, if anyone wants to look into this, it's called beneficial ownership. And I have a few cases. I just got them actually, 2 of them, and one I've had for a long time. The question is, who's the real owner of the property, right? So if you give money to an 18-year-old to buy a house and you make all the payments, and when you eventually sell the place, it goes back into your bank account, that doesn't work. The rule is that actually that will get reattributed back to the adult parent rather than it being the kid.
So you have to actually make sure you keep all your accounting, everything, that the money actually
Separate.
stays with the thing. And I think before the webinar, we were talking about, we really have to show it as a gift
Yes,
that is given.
I would do that. And as we were talking, most real estate agents would be familiar with a gift letter. It's a pretty common thing to ask for, I think, as far as I know. So I would definitely get one. And like I said before, the best time to get documents is when you're doing things. So in that moment, get it signed, have it dated as of that date. You show that to the CRA, dated as of the correct date. That's way more persuasive than you doing the same letter. Oh, but it's signed years later, only after you audited me. They're going to say that's very convenient.
Yeah, I know a lot of people also have a question where they say, is it advantageous for me or the parents? So I mean, the parents say, for example, they are now 70, in their 70s.
Yeah.
And they say, oh, I'm not sure what's really going to happen with the principal residence or the probate or whatever. So how is it beneficial for them? Now, do they keep it under just the parent's name? Because I had a case here where I think the brother and sister actually, sold the property once the mom passed away. And what they did is on the probate, they actually showed a lower value because you want to pay as low probate fees as possible.
Okay.
And then the CRA came back to them and then they sold it. At like 100,000 more. And then the CRA came back to them and said, oh, now you actually owned it and you sold it within a year because probate took some time. So you had to pay for the difference. So what I actually informed them is that go back to the lawyer who actually closed the deal, show them the actual value of the property that got sold. That value was very similar to when they did the probate. And then they actually went and paid 6,000 probate tax instead of a capital gain tax of 60,000.
Interesting.
Wow. Yeah. So that sometimes, people sometimes have the question, should I, take over the title along with my parents while they're alive, or should they wait until the parents passes away? What would you say to that?
I would say there's no general answer to that question. It's a very bad answer. But if you're thinking about doing that, you have to get someone to look at it. I know that's not what people want to hear, but it's so situation specific. And look at what I just talked about. The stakes with this stuff they're really high. And if you misstep, you don't want to lose part of your principal residence exemption just to save on probate. It probably doesn't work out in your favor. There's the analogy of picking up pennies in front of a steamroller, right? So you don't want to be in that situation. That's what I'd say. So just worry about the big ticket rules first, and then as long as you're on side, then you can deal with potential probate issues.
Now, I know we wanted to make the session like 45 minutes. Now, I know we have a lot more questions, but I know a lot of it also has to do with estate planning and also other areas. And so what I know was, I thought I saw something on the screen. There was some question. Was there some question on the screen to do with HST, or was that answered? I'm not sure. Yeah, was there any question there? I know, because I know there's a lot more questions where, we're going to let Bruce know about those questions, and then we'll get answers after. It was something that came up on the chat. Actually, look at the chat. There was one here. HST at the time of sale on substantial renovation, is this applicable to primary residence?
So if you can show that it was your principal residence, you won't have to pay HST. There's a specific exemption for that.
Right.
If you want to look it up, it's 191 bracket 5 of the Excise Tax Act, which I know is a mouthful. 191 sub 5 is what you have to look up. So basically the answer is no. If you do the substantial renovation and you live there, you're okay. But the problems where I see it happen is if you do the substantial renovation and then for any reason you end up selling that place, that looks pretty bad.
Right.
And then you face an uphill battle. So if you're going to do something like that, be very careful and really make sure you truly intend to live there. Because the CRA, they're looking at those transactions very heavily right now. And it's very easy for them to pull the permits that you had to get the plans approved. So they're very much on top of that, and they're looking for people to send audit letters to.
Yeah, good. So I think, we have covered a lot of topics, and there are a lot of other questions to deal with, estate, probate, and corporations, and investment properties. So those are questions that we have, and there are expertise in Bruce and also in your firm, right?
Yeah.
And so that's something that we can get answers to. And so I think it was a great presentation.
Yeah, thank you.
Yeah, really
It flew by.
Yeah.
Wow.
Wow, it's like what?
Holy smokes.
Almost 45
Yeah,
minutes.
wow.
So we are almost in time. So, but thank you to all of you for joining. We really appreciate that. And, we want to get answers to a lot of all the questions that our clients are asking. And that's why we're bringing in experts to, answer those and have a presentation. So once again, thank you to all for joining.
May I give a plug
Yeah,
to our firm?
yeah.
So if any of you have any tax questions at all, you can give my firm a call. We can set up a consultation. Sometimes if you just need to ask a couple questions and get some input, that's a service we can provide.
Yeah.
If it's something bigger, if you've actually gotten an audit letter or someone you know gets an audit letter, definitely feel free to send them our way, and we can see if we can help them.
Yeah, and I know, Bruce, last time when we did the webinar with
James.
from Farber.
Yeah.
They had given out the first consultation, like over the phone, like a free consultation.
Yeah, we do that.
Are you willing to do that?
Yeah, we do that. It depends on what the person's looking for. So if you just want to ask a couple questions, and that you just need an answer, that you would have to pay for. But if you got an audit letter, if it looks like you're in the thick of it in a big tax dispute, then we do a free consult, and we're happy to talk about it. But just give us a call and we'll figure it out.
Yeah, and thank you for all the attendees. And so we would be, drawing the free Blue Jay giveaway next week on Monday, and we'll let you know who would be the lucky winner. So
nice.
For all these
Yeah.
spin the wheel.
Yeah.
Oh, nice.
Yeah, good. So thank you everyone
Okay.
for joining, and have a great evening.
Okay. Bye.
Bye-bye. Bye.